Welcome, I'm Patrick Beecraft, and today we're going to be covering the fundamentals of capital budgeting. Let's first go over some terminology for capital budgeting. What is a capital budget and capital budgeting? A capital budget lists the projects and investment that a company plans to undertake during the next period, and a capital budgeting is the process of analyzing projects and investment opportunities and deciding which ones to accept. Other terms to know are going to be incremental earnings, the amount by which a firm's earnings are expected to change as a result of an investment decision; straight line depreciation, a method of depreciation in which an asset's cost is divided equally over its life; and marginal corporate tax rate, the tax rate a firm will pay on an incremental dollar or pre-tax income. Pro forma describes a statement that is not based on actual data, but rather depicts a firm's finances under a given set of hypothetical assumptions: unlevered net income, an income that does not include interest expenses associated with debt; and free cash flow, the incremental effect of a project on a firm's available cash. Trade credit, the difference between receivables and payables, the credit that a firm extends to its customers. Depreciation tax shield, the tax savings that result from an ability to deduct depreciation. Opportunity cost, the value a resource could provide in its best alternative use. Scenario analysis, an important capital budgeting tool that determines how the NPV varies as multiple project parameters are changed simultaneously. Project externalities, indirect effects of a project that may increase or decrease the profits of other business activities of a firm. Cannibalization, when sales of a firm's new product displace sales of one of its existing products. Sunk cost, an unrecoverable cost which a firm is already liable. And overhead expenses, expenses associated with activities that are not directly attributable to a single business activity, but instead may affect different areas of a corporation. MACRS, or Modified Accelerated Cost Recovery System, depreciation, the most accelerated cost recovery system allowed by the IRS. Based on the recovery period, MACRS depreciation tables assign a fraction of purchase price that the firm depreciates each year. Tax loss, carryforwards, and carrybacks, two features of the U.S. tax code that allow corporations to take losses during a current year and offset them against gains in nearby years. Sensitivity analysis, an important capital budgeting tool that determines how the NPV varies as underlying assumptions change one at a time. Break even, the level of a parameter for which an investment has an NPV of 0. Break even analysis, a calculation of the value of each parameter for which the NPV of the project is 0. And the EBIT breakdown or break even, the level of a parameter or a particular parameter for which a project's EBIT is 0. And lastly, real option, the right to make a particular business decision, such as a capital investment; option to delay commitment, the option to time a particular investment; option to expand, the option is to start with a limited production and expand only if the project is successful; and the abandonment option, the option for an investor to cease investing in a project. Now that we've taken care of our terminology, let's look at what I believe to be the most important information from this chapter: calculating free cash flow directly. The formula for that is going to be your cash flow equals revenues minus cost minus depreciation times 1 minus your tax rate plus depreciation minus capital expenses minus the changes in the NWC. Note that we first deduct depreciation when calculating the project's internal earnings, and then add it back in when computing free cash flow. When it comes to the levels of businesses, I believe that all levels of business are going to be able to use this information pretty well equally. You're going to be using it to make judgments whether or not the company should continue down the path with some of its projects, if they should enlist new ideas to the corporation, or if they should start cutting costs when it comes to some failing projects. and to bring it all together with the Bible and how I feel it affects what we're going through. And the best verse I believe we can take from this or compare it to is going to be 2 Corinthians 9:6. Now this I say, he who sows sparingly will also reap sparingly, and he who sows bountifully will also reap bountifully. In this, I believe I see what we're trying to do. Make sure we invest properly and invest for the future, making sure that what we are investing in is going to be most profitable for our corporations, for our firms, and bringing us the best returns possible. And that brings us to the end of this week's video. Hopefully you've enjoyed what I've produced here, and hopefully you've learned a little bit about capital budgeting. Have a great week.